So guys, here's a quick revision of Accounting Standard 9. First, AS9 guys deals with revenue recognition. The definition of the word revenue is that it is a gross inflow of cash, receivables or other consideration. I will do it guys in 2 minutes please. Alright. After that you also do it. Let me talk. Just check if I remember the correct thing or not. So revenue is a gross inflow of cash, receivables or any other consideration as such beta from sale of goods or rendering of services that is arising in the ordinary course of business. Apart from that, use of enterprise resources by others, resulting in interest, dividend, and royalties. So prima facie, we are covering two things. One is revenue arising in the ordinary course of business, which can either be from sale of goods or from rendering of services. The other one beta is other income comprising of what? Interest, dividend, and royalty income. The consideration need not be only in the form of cash, it can be in any form, as long as you're receiving consideration against these resources. Now, for an agency business, I told you consideration cannot be considered to be the total gross inflow of receivables. It is only the amount of commission income that should be considered as your revenue. Because the risk and rewards of ownership are not transferred to an agent as such guys, we only take the commission income. In case risk and rewards of ownership are transferred, it can no longer be considered as an agency business. Then the entire inflow of cash will be considered to be revenue. Any aspect is such beta that is covered by another accounting standard guys will not be covered by Accounting Standard 9. Though non-applicability part here is not that relevant, not that important as such beta. But then prima facie, how will you remember? Anything that is covered by another accounting standard will not be covered by Accounting Standard 9, AS9. The most important part that we cover in this standard is the timing of revenue recognition. When are we supposed to book revenues is the most important aspect in determining profitability of an organization. For this, the very first thing that we did beta was sale of goods. When it comes to sale of goods, I said revenue can be recognized only when the risk and rewards incidental to ownership are transferred to the buyer, consideration is measurable, and there is no uncertainty in realization of the amounts. Only when these conditions are satisfied, revenue can be booked. If these conditions are not satisfied, you cannot book revenue against sale of goods. We did a lot of special cases with again under sale of goods. Now, the first one beta there was if there is delayed delivery at buyer's request. I said if the goods have already been manufactured and are earmarked for delivery. When I say earmarked for delivery, they should be set aside for delivery. Then even if the delivery is delayed at buyer's request, you should book revenue provided the title and goods, that is the effective risk and rewards of ownership, are transferred to the buyer. If it is delivery subject to installation and inspection, this should be specified in the question guys, that the buyer is going to accept the product only after the product is installed and inspected. Only if that happens as such guys, you're supposed to recognize revenue after the installation process is completed and it is accepted by the buyer. Otherwise guys, we did a couple of questions in which there was installation amount being charged separately, there was sale of goods being charged separately. The question clearly specified that the machinery was already accepted by the buyer, but the installation process was performed in the next year. We've decided that you should book revenue in respect of sale of goods immediately, but as far as the installation revenue is concerned, we will be booking that in the next financial year. When goods are sold on approval basis, because the effective risk and rewards of ownership are not transferred to the buyer. When you say risk and rewards of ownership are transferred, beta is accepted the ownership in goods. Here you're selling goods on approval basis. So till you either receive the approval or till a reasonable time period has lapsed, you will not be able to recognize revenue. When goods are sold under return guarantee of return as such beta, that is guaranteed sales, you are supposed to book immediate revenue. However, it will be appropriate to make a provision for the expected amount of sales returns, because it is not expected that every customer is going to return the product. That is why we book the entire revenue and then we make a provision for sales returns. When goods are given to your consignee guys, it is again your agent of the organization, because the risk and rewards of ownership are not transferred. He's merely liable to sell the goods better. He is not responsible for the value of those goods. That is why you will not be able to recognize revenue till those goods are in turn sold by consignee to a third party. Only when they are sold to an external party, you will be able to recognize revenue. When it is cash on delivery sales as such guys, only when the amount is received from the buyer as such, but the product is delivered, you will be able to recognize revenue, because usually in COD sales as such, guys, the buyer has the right to refuse delivery. In that case, the risk and rewards incidental to ownership will not be transferred to the buyer. When you're making a series of payments to the seller of the product as such, guys, and then upon the payment of the last installment, you take delivery of the product, you will be able to recognize revenue only when the product is delivered, because till then as such, but the risk and rewards incidental to ownership are not transferred to the buyer. This is different from installment sales. यहाँ पे you are receiving amount first, guys. Under installment sales, the product is being delivered. Against that, you will be receiving the amount in installments along with interest component. If that is a scenario, guys, you're supposed to book revenue immediately, equivalent to your cash price. Whatever amounts that you're receiving on a later date will amount to receipt of interest and principal component. Are we clear about that? Next. In case of special order shipments, that is wherein you first receive money from the buyer of the product and then you undertake manufacturing activity, guys, and then deliver the product. You're supposed to recognize revenue as and when the goods are manufactured and are ready for delivery. You have manufactured the product only for that customer as such, better. So as and when you performed your task, you can recognize revenue because the consideration is already received. Did you not receive advances against it? Next. In case there is a sale or repurchase agreement, I said go by substance over legal form. A sale and repurchase agreement does not result in transfer of risk and rewards incidental to ownership. You're selling the product today, but you will have to buy back the same product on a later date as such, guys, at a higher price. Irrespective of the actual price prevailing on a later date, the price is predetermined. So there is no risk and rewards of ownership transferred to the other person. That is why, beta, this is considered as a loan transaction. The difference between sale and repurchase price will be the amount of interest to be booked by the seller of the product. We will book that as expenditure. The other person will book that as income. And then, guys, if you are selling to intermediate parties, better, intermediate parties and consignees are two different things. Intermediate parties are usually external to the organization, distributors, stockists, and all of them, better. So as and when the products are sold to these intermediate parties, better, the risk and rewards of ownership are transferred and you can recognize revenue. Just when we saw Tata Motors ka annual report, they said that when the products are delivered to dealers, you directly recognize risk and you directly recognize revenue. In respect of exports, better, they say when it is delivered to the carrier. So on mein aa raha hai. When there is subscriptions for publications as such, guys, because publications will be released over a period of time, you are not supposed to book the entire amount of revenue immediately. You will book that as revenue over the entire period. As and when each publication is released as such, guys, you will have to book a proportionate amount of revenue. That proportionate amount will depend on what is the sale value of that publication and what is the overall sale value of all the publications collectively. I gave the example of Forbes magazine as such, guys. If say each publication is 200 rupees and in a year the total value of all the publications is 3000, then 200 by 3000 into whatever is the amount will be the amount of revenue to be transferred to P&L. Correct? Installment sales already done. As far as trade discount and volume rebates are concerned, I said because they directly arise in relation to your selling activity, they should be adjusted from the amount of revenue that is booked by the organization. Only the net amount of revenue, better, will be transferred to your P&L statement. After sale of goods, better, we moved on to rendering of services. In rendering of services, better, there is no tangible property that is being transferred as such, guys, from the buyer to the seller. That is why, guys, here we talk about consideration is measurable and then there is certainty of collection. Apart from this, guys, I said there are two methods that are prescribed for rendering of services. One, beta, is completed service method. The other one is proportionate service method. If the service that is being rendered as such, guys, is on a recurring basis, you will have to book revenue on proportionate completion method. The example for this, beta, was internet subscriptions, telecom subscriptions. If you are paying prepaid amount as such, beta, for the entire year, shouldn't they book revenue on a proportionate basis? Or gym memberships also as such, beta, the other person has to book revenue on a proportionate basis. So it is usually done on a straight line basis unless there is some other pattern which better signifies the pattern of economic benefits. Under completed service method, guys, the service is not regarded as completed as such, but till the final act is performed. That is why you will be able to book revenue as such, guys, only upon the completion of the entire service. Example for this, beta, that I told you was website development, guys, or Audit services, guys, legal services, doctor services, all of these are considered as completed only when the final act is performed. So this was under rendering of services. The special cases that we did better under rendering of services were, in case of installation fees, I said obviously better you will be able to book revenue only when the installation is completed. As far as advertising income is concerned, better advertising income should be booked as revenue as and when the advertisement is brought before the public. As and when it is broadcasted as such, better you will have to book revenue. If that advertisement income is for multiple publications, even then you have to do it on a proportionate basis. As far as insurance agency commissions are concerned, guys, it will be from the effective date of policy commencement. It is only then better that the service is considered as completed. Financial service commissions, it will depend on whether you are rendering a regular service, ongoing service better, or is it a one-time service. If it's a one-time service as such, guys, you're supposed to do it only after the completion of the entire service. If it's a regular service, ongoing service as such, guys, you're supposed to book revenue on a proportionate basis. Are we clear? Just I gave an example of CA beta retainership. If a CA is retained by an organization and they give him a monthly payment as consultancy fees, you can do that. You can book that as revenue beta every month. Admission fees for any event as such, guys, or any wedding halls ka bhi better, you will have to book that revenue only as and when the event is undertaken. Tuition fees, as said, should be booked proportionately over the entire period of service. Entrance fees as such, guys, is usually capitalized. Membership fees better will be done on a proportion. If it is annual membership fees, pura ka pura beta will get transferred to your P&L account. But if it also includes advances for the subsequent periods as such, guys, you should only transfer the amount that relates to the current year to P&L account. The balance amount will be transferred to in the period beta to which it relates to. After that beta, we did use of enterprise resources by others. There were three things here: interest, dividends, and royalties. Interest should be recognized on a time proportion basis after considering the amount that is outstanding and the interest rate applicable. Royalties should be recognized on an accrual basis. If it is based on production, it accrues as and when the goods are manufactured. If it is based on sales, it accrues as and when the goods are sold. Dividends should be recognized only when the right to receive payment is established. There is no accrual basis for dividends. There is no time proportion because you do not have the right to receive a fixed amount of dividend. That is why we are supposed to book dividend only when the right to receive payment is established. And such right will be established usually when the dividend is declared in the general meeting or the board meeting, depending on whether it is interim dividend or final dividend. In all of these cases, beta, you should be able to book revenue if and only if there is certainty of collection. One example that was given there is in case the company which is declaring dividend beta is under severe exchange control restrictions. Though they are declaring dividend, you know that they will not be able to remit money outside the country. If they're not able to remit the money outside the country, you should not be booking it as revenue because there is no certainty of collection. Now, apart from this, but I said if the revenue recognition criteria is not met, just say if consideration is not measurable, you're supposed to postpone revenue recognition. If there is no certainty of collection, even then you're supposed to postpone revenue recognition. In case beta, after booking revenue, if there is uncertainty of collection, you're supposed to make a provision for doubtful debts after booking revenue in case uncertainty arises. Whenever you are postponing revenue recognition, if at all the conditions are met in the subsequent periods, you will have to recognize that as revenue beta in the period in which the conditions are met. Are we clear about this? And as far as disclosure policies are concerned, but you're supposed to disclose whatever is the amount, whatever is the accounting policy that is being followed. And if your company specific accounting policies should be disclosed. Every company may have a different product, different service beta that is being rendered. So you'll have to disclose whatever is the accounting policy. And in case revenue recognition is postponed, you will have to specify what are the uncertainties on account of which revenue recognition has been postponed. This is what we have learned beta under AS9. Are we clear? Now, no one is going to talk, guys. Here's a quick revision of Accounting Standard 12, Accounting for Government Grants, guys. The very first thing that you have learned in this standard is the definition of the word government. I said the word government refers to international, national, state, or local government bodies. We are not covering any private organizations here. Government grants are the assistance that you're receiving from the government in cash or in kind for past or future compliance with certain conditions. If you cannot place any value on the grant that is being received as such, beta, it cannot be accounted as a grant. I told you, if the government is developing infrastructure in general, it is going to indirectly benefit your business. But you cannot disclose that as a government grant because you are not directly deriving any benefit out of it. Also, if there's any transaction with the government as such, beta, in the ordinary course of business, or government is investing in your business as a shareholder, that cannot be accounted as a government grant. That's normal issue of shares and those are normal business transactions. So this standard, apart from this, talks about when should you be recognizing government grant, what will be the accounting for government grant, what will be the accounting for refund of government grant, and disclosure requirements. As far as recognition criteria is concerned, there are two basic conditions. First one, beta, it is reasonably certain that we are going to comply with all the conditions that are attached to the grant. Already compliance nahi beta, you are expected to comply with those conditions over a future period, whatever is the specified number of years. Second condition, beta, is that it is reasonably certain that the collection will be made, the grant will be sanctioned, you will be entitled to those funds, beta, and the benefits have been earned. Only then you can recognize government grant in your books of accounts. This deals with timing of revenue, timing of government grant recognition. If the grant is something that you have been applying on a regular basis, you can happily recognize that as such, but at the time of application only. If you have never applied for that grant in the previous years, guys, and this is the very first time that you're applying the grant and you're not sure whether the grant will be given or not, then you can recognize grant in the year of approvals. Jab grant sanction hota hai. There was one question, beta, in which we recognized the grant 4 years later, 3 years later, guys, only when the grant was sanctioned. Are we clear about this? Now, having said that, beta, if you are recognizing grant only when it is being received as such, guys, you're again violating accrual concept as per AS1, not allowed. Also, just because you've received a grant, that does not mean recognition criteria is met. You still have to satisfy the first condition, guys. That means conditions attached to the grant, beta, should expect it to be satisfied. Only then you can recognize grant in your books of accounts. Any receipt of grant, beta, cannot be considered as an extraordinary item except under two cases. If you're receiving grant, guys, for past expenses or for immediate financial assistance, only then you will consider receipt of government grant as an extraordinary item. As far as recognizing grant is accounting for government grant is concerned, guys, I said we have to divide them into two broad categories: non-monetary grant and monetary grant. Under monetary grant also, beta, you will have grant in respect of capital expenditure, grant in respect of revenue expenditure. Capital expenditure again, beta, will be specific asset which can be depreciable or non-depreciable or an entire project. In case you're receiving a non-monetary grant as such, guys, because you're directly receiving the asset from the government at zero cost, you're going to record that asset in your books of accounts at nominal value. If you're receiving an asset beta at concessional rate, you will record the asset directly at the actual consideration paid for that asset. In case you're receiving grant in respect of an entire project, the wordings, beta, will be you have put up a plant in a specified backward area, or if you've started a particular line of business, then the grant, beta, will be considered in the nature of promoter's contribution, meaning it will be transferred to capital reserve. This is not a realized profit, cannot be used for any distribution of dividend. It will stay as capital reserve for the life of the company. If the grant is received in respect of a specific depreciable asset, you have two alternatives. Either you reduce that grant from the cost of the asset, or you transfer that grant, beta, to deferred government grant account. If you're transferring it to deferred government grant account, it should be amortized in the ratio of depreciation. Either ways, the impact on P&L will more or less be same. If you're reducing it from the cost of the asset, depreciation amount itself will be lower. If you're not reducing it from cost of the asset, beta, you transfer depreciation on full amount, and then you also transfer deferred government grant separately. Are we clear, guys? If the grant is in respect of a specific non-depreciable asset, two alternatives: reduce from the cost of the asset or consider it as capital reserve. Why do we consider that as capital reserve? Because nothing related to this asset goes to profit and loss account. However, what is the catch here? If there are conditions yet to be met, then, guys, you can transfer grant to deferred government grant account and amortize it as and when the corresponding expenditure is being incurred. Final beta, if the grant is received in respect of revenue expenditure, then because revenue expenditure goes to profit and loss account, even the grant amount beta should be transferred to P&L account. However, there are two ways of disclosing that in your P&L statement. Either disclose expenditure under expenditure side, grant under other income, or show expenditure net of grant directly on the expenses side. Are we clear? Irrespective of how are you disclosing it in your P&L statement, journal entries will not change. You remember that? Next comes with a refund of government grant. Whenever the company has to refund the government grant, beta, the accounting treatment for that will be exactly reversal of what was done earlier. If the grant as such, guys, was debited to P&L account, was credited to P&L account, it will now be debited to P&L account. If the grant was reduced from cost of the asset, it will now be added back to the cost of the asset. If it was transferred to capital reserve, debit that to capital reserve. If the grant was transferred to deferred government grant account, to the extent the balance is lying in deferred government grant account, you will adjust it against that. The balance will be transferred to profit and loss account. So, on mein aa gaya, guys. Any refund of government grant is always to be considered as an extraordinary item. This is what we have learned under AS 12, nothing else. Obviously, problem solving is very important. Okay, guys? Yes or no? The next revision, guys, is of buyback of equity shares. गला बैठ गया यार इतनी जल्दी, वो ज़्यादा चला रहा है। हाँ हाँ, क्या होता है वो इसकी वजह से सब होता है। चल, all right, guys, talking about buyback of equity shares. First, why is buyback important? I said equity shares are perpetual securities as such, guys. There is no way that equity shareholders will be paid back their amount till the company is liquidated. However, there are provisions under Companies Act beta which entitles a company to buy back their own equity shares even before the liquidation of a company. You can buy back shares from the market. When will companies undertake buyback? Financially matured companies that have huge amount of resources as such, guys, can distribute cash to the shareholders in the form of dividend or through buyback of equity shares. You distribute cash to the shareholders in the form of dividend if the company can sustain that amount of dividend year after year, because declaring dividend increases the expectations of shareholders. If not that as such, guys, you can always buy back equity shares. Buying back equity shares does not mean that the company will undertake buyback every year, guys. Also, guys, what happens when you buy back shares is that the earnings will now get divided by lesser number of shares. That increases your earnings per share, that in turn will increase your market price per share. This is one way how Apple was able to increase their EPS year after year. Apple has bought back stocks worth $500 billion cumulatively over the last couple of years. $500 billion is almost triple the amount of market capitalization of Reliance Industries. But they have such huge amount of cash balances as such, but their profitability annually is closer to $100 billion. So for them it is not a big amount. They undertake stock buybacks. That is their way of increasing the wealth of the remaining shareholders, because the earnings per share will increase. That in turn will result in an increase in market price of the share. I also told you few promoters might undertake buyback as such as a measure to prevent takeover. If someone else is acquiring your shares from the market, you yourself will give an offer to the public so that they give away shares, and the effective number of shares with the public will reduce. Irrespective of the reason, guys, what we are learning here is only the accounting for buyback. Section 68 of Companies Act as such deals with accounting for buyback. As per Section 68, a company can undertake buyback of its shares either out of free reserves or out of securities premium, guys, or out of proceeds of fresh issue of shares. This point has been included in order to ensure that you comply with the provisions of Section 69. Section 69 deals with creation of CRR, Capital Redemption Reserve. Every time there is a reduction in the paid up share capital of a company, guys, an entity should ensure that they create CRR out of free reserves. You are paying capital. To that extent, we will not let you pay dividend. So you will have to convert free reserves into CRR to the extent of reduction of paid up share capital. If you are redeeming preference shares by issuing equity shares, CRR is not required. If you are buying back equity shares by issuing preference shares, CRR is not required. You are redeeming preference shares by issuing new preference shares, CRR is not required. CRR will be required if and only if there is a reduction in the paid up share capital. Next, guys, there are certain conditions prescribed under Section 68, guys, subject to fulfillment of which only you can buy back equity shares. The first test is such, beta, first condition was shares outstanding test. The number of shares that you can buy back cannot exceed 25% of the total equity shares outstanding. So if a firm has 1 crore shares outstanding as such, beta, you will not be able to buy back more than 25 lakh equity shares. The second test, beta, is resource test. The total amount of money that you are utilizing for the purpose of buyback cannot exceed 25% of equity. Equity for this, beta, means paid up equity share capital, paid up preference share capital, free reserves and securities premium. What do you see on the screen? Any other reserve, guys, will not be included in the definition of equity. You only include paid up share capital, both equity and preference, free reserves and securities premium. In fact, the wording in the standard, beta, is paid up capital plus free reserves. And then they mention securities premium is considered as a free reserve for the purpose of this section. I said, remember it as paid up share capital plus free reserves plus securities premium. Okay, guys. So if case ये example में बेटा our total equity is 50 crore rupees, 25% of that will become 12.5 crores. You will divide 12.5 crores by buyback price. I took an example of buyback price being 600, guys. So if I divide 12.5 crores by buyback price, I will get the maximum number of shares that can be repurchased as per condition 2. The most important one, beta, was condition 3. As per condition 3, that is debt equity ratio test. Post buyback, your debt equity ratio cannot exceed 2:1. This is to ensure, beta, that entities with substantially higher amount of debts do not undertake buyback. If you have surplus funds available, use them to reduce your debt first instead of buying back your equity shares. Though I told you, beta, general business practice, entities with debt do not undertake buyback also. They will always use their money first to reduce debt. Mostly, guys, only zero debt companies are the ones who undertake buyback of equity shares. Now, this third condition, beta, is post buyback debt equity ratio, not pre-buyback. Debt for this purpose includes both short-term as well as long-term liabilities, not just borrowings. Any amount of liability as such, beta, should be included in the definition of debt. So you substitute debt in that formula and compute what should be your post-buyback minimum equity. That you will compare with pre-buyback equity. The difference will be the maximum reduction possible in the amount of equity. जैसे अपने example में we took debt of 90 crores, beta, we got post buyback equity to be 45 crores. ऊपर already देखे, beta, that pre-buyback equity was 50 crores. So you can reduce 50 crores to 45 crores. Maximum reduction in the value of equity is 5 crores. Now coming to an important point. This 5 crore rupees you will not divide by buyback price. You should divide by buyback price plus transfer to CRR. What is the reason that I told you? Every time you buy back an equity share, our example face value was 10 rupees, premium on buyback was 590 rupees. You are paying 600 rupees to the shareholder. So your equity share capital will reduce by 10 rupees, your reserves will reduce by 590 rupees. Yes or no? Apart from that, beta, because there is a buyback of share, because there is a reduction in paid up share capital, you will transfer free reserves to CRR. CRR is not included in the definition of equity for the limited purpose of section 68. That is why this maximum reduction in equity should be divided by buyback price plus transfer to CRR. In our example, it is 610 rupees. That will tell us how many shares can be repurchased. Are we clear, guys? A company cannot undertake buyback if it is not authorized by its articles. A special resolution is required to be passed. You cannot undertake a buyback offer for at least 1 year from the conclusion of the previous buyback offer. Directors of the company should give a personal affidavit as such, that the company will not be insolvent. If the company goes in for insolvency within the next 1 year, they are personally liable for all the debts of the company. सोचो अगर तुम लोग buyback करके बेटा you go in for insolvency, did you not jump the line now? You paid off your equity shareholders first. Now you are telling the debt holders better that we do not have money. So directors will be personally liable, guys, for all the debts of the company. That is why I said, beta, usually debts wale company will never undertake buyback also. After this, beta, journal entries. Under journal entries, beta, I said the very first entry, guys, will be equity share capital account debit. This is for face value. Premium on buyback account debit to equity shares buyback account. You pay them off for the entry for which, beta, will be equity shares buyback account debit to bank account. After that, beta, this premium on buyback will be adjusted against securities premium. If securities premium is not sufficient, then you will use. So the entry for that, beta, will be securities premium account debit, free reserves account debit to premium on buyback. because you are buying back equity shares and there's a reduction in equity share capital, you'll also have to create CRR. The entry for which beta will be free reserves account debit to CRR account. Do not forget, CRR should be created only out of free reserves. It cannot be created out of any other reserve. Are we clear, guys? When you're presenting a balance sheet, guys, do not forget to disclose under share capital note the number of shares that were repurchased during the year. This is a requirement as per schedule 3. Are we clear, guys? This is what we have learned beta in buyback of equity shares. ठीक है beta? Alright, guys.